If you made less money in the last bull market than you expected, this is why. Bull markets don't make people rich. They expose who doesn't know what they're doing. Most people think they lose money in markets because things are unpredictable. That's not actually the problem. People lose money because they misunderstand how risk, time, and behavior interact, even when markets are going up. This channel exists to explain those mechanics clearly, without hype and without shortcuts. Section 1. The illusion of bull markets. Bull markets create a false sense of competence. When prices rise consistently, bad decisions aren't punished right away. They're rewarded temporarily. People start confusing luck with skill, activity with progress, and participation with understanding. A rising market doesn't remove risk. It hides it. That's why many investors feel confident right before things break. Section 2. The first quiet reason people lose money. Time mismatch. Most people say they're long-term investors, but they behave like short-term decision-makers. They check long-term investments daily. They react emotionally to short-term movement. This creates a mismatch between the asset and the behavior. Long-term assets require patience. Short-term monitoring creates anxiety. And anxiety leads to unnecessary decisions, which quietly erode returns. If you remember one thing from this video, it's this section 3. The second reason: misunderstanding risk. Risk is often confused with volatility. Volatility is movement. Risk is permanent loss. In bull markets, volatility feels like danger even when it isn't. So people sell not because something is broken, but because something feels uncomfortable. The market doesn't punish discomfort. It punishes inconsistency. Section 4. The third reason: behavioral leakage. Most losses don't come from dramatic mistakes. They come from small, repeated ones. Overtrading as a behavioral mistake. Strategy changes mid-cycle. Chasing what recently worked. These actions feel minor in the moment, but over time they compound in the wrong direction. Most investors don't fail loudly, they leak quietly. Section 5. What actually works instead. Good investing usually feels uneventful. It involves fewer decisions, clear time horizons, accepting boredom as a feature, not a flaw. The goal isn't to feel active. The goal is to be consistent. Systems outperform impulses, especially over long periods. On this channel, we'll focus on understanding financial systems, not predicting headlines. If that approach is useful to you, you can subscribe.